Question 1. An insured has a personal auto policy with liability coverage limits of 100/300/50. What does the 50 represent in these limits? A. $50,000 for medical payments coverage per person. B. $50,000 for property damage liability per accident. C. $50,000 for bodily injury liability per person. D. $50,000 for uninsured motorist coverage. Answer: B. $50,000 for property damage liability per accident. Personal auto policy liability limits are often expressed as split limits, which denote the maximum amounts the policy will pay for different types of losses. The 50 in 100/300/50 specifically refers to $50,000 for property damage liability coverage per accident, meaning the insurer will pay up to that amount for damage caused to other people's property. The first number covers bodily injury per person, the second covers bodily injury per accident, and the third is for property damage, serving as a reminder of how liability limits are structured. Question 2. Which of the following is not an essential element of a legal contract in insurance? A. Offer and acceptance. B. Competent parties. C. Unilateral agreement. D. Legal purpose. Answer: C. Unilateral agreement. A unilateral agreement describes a characteristic of insurance contracts, not an essential element for a legal contract's formation. The four essential elements of any valid contract are offer and acceptance, agreement, consideration, an exchange of value, competent parties, legal capacity, and legal purpose, not against public policy. While an insurance policy is a unilateral contract because only the insurer is legally bound to perform after premiums are paid, this characteristic is not a requirement for the contract's initial validity. Question 3. What is the primary purpose of a deductible in an insurance policy? A. To increase the insurer's profit margins. B. To reduce the number of small claims and control moral hazard. C. To provide additional coverage for specific perils. D. To simplify the claims process for both parties. Answer: B. To reduce the number of small claims and control moral hazard. A deductible is the amount of money the insured must pay out of pocket before the insurer begins to pay for a covered loss. Its primary purpose is to reduce the number of small, frequent claims and to discourage moral hazard, which is the tendency for insureds to be less careful with their property if they know insurance will cover all losses. For instance, if a homeowner has a $1,000 deductible, they are less likely to file a claim for a minor repair costing $500, which helps keep premiums affordable for everyone. Understanding deductibles helps you explain why an insured might still have an out-of-pocket expense even after a claim. Question 4. An insured's dwelling is severely damaged by a fire. The cost to rebuild the home is $300,000. However, due to depreciation, its actual cash value at the time of loss is $200,000. If the policy has a replacement cost endorsement, how much will the insurer pay, assuming no deductible? A. $200,000. B. $250,000. C. $300,000. D. The policy limit, which could be less than $300,000. Answer: C. $300,000. Replacement cost coverage pays the cost to repair or replace damaged property with materials of like kind and quality, without any deduction for depreciation. Since the question specifies a replacement cost endorsement, and the cost to rebuild is $300,000, the insurer will pay the full rebuilding cost, assuming it's within the policy limits. This differs from actual cash value, ACV, which would subtract depreciation, highlighting the significant benefit of replacement cost coverage for the insured. Question 5. Under a standard homeowners policy, HO3, which of the following is typically covered under coverage C, personal property? A. The dwelling itself. B. Other structures on the residence premises. C. personal property owned or used by an insured, anywhere in the world. D. Loss of use of the dwelling after a covered loss. Answer: C. Personal property owned or used by an insured, anywhere in the world. Coverage C in a homeowner's policy is specifically designed for personal property. It typically provides broad coverage for the insured's belongings, whether they are located at the residence premises or anywhere else in the world, subject to certain limitations for specific types of property. This means if an insured's laptop is stolen while on vacation, it would generally be covered under their homeowner's policy, illustrating the worldwide coverage feature. Question 6. The principle of utmost good faith in insurance implies that A. The insurer must always pay claims without question. B. Both the insured and insurer must deal with each other in an honest and open manner. C. The insured must prove their financial stability before obtaining a policy. D. Only the insurer is bound by legal obligations to the insured. Answer: B. Both the insured and insurer must deal with each other in an honest and open manner. The principle of utmost good faith, uberrimi fidei, is a fundamental concept in insurance, requiring both parties to an insurance contract, the applicant/insured and the insurer, to act with complete honesty and disclose all material facts relevant to the contract. This means the applicant must be truthful in their application, and the insurer must be fair in handling claims and policy terms. It fosters trust in the contractual relationship, ensuring that the agreement is based on accurate and complete information from both sides. Question 7. What is the primary purpose of workers' compensation insurance? A. To provide health insurance for employees not covered by group plans. B. To compensate employees for lost wages due to non-work-related accidents. C. To provide medical care and lost wages for employees injured on the job, regardless of fault. D. To protect employers from all forms of liability arising from employee actions. Answer: C. To provide medical care and lost wages for employees injured on the job, regardless of fault. Workers' compensation insurance is a state-mandated program designed to provide benefits to employees who suffer job-related injuries or illnesses, including medical expenses, rehabilitation, and a portion of lost wages. A key characteristic is that it operates on a no-fault basis, meaning an injured employee is entitled to benefits regardless of who was at fault for the injury, which protects both the employee and the employer from lawsuits. It's a crucial protection for the workforce, ensuring injured workers receive necessary support. Question 8. In property insurance, what is a peril? A. A condition that increases the chance of loss. B. The cause of loss. C. The amount the insured must pay before the insurer pays. D. The financial loss itself. Answer: B. The cause of loss. In insurance terminology, a peril is defined as the direct cause of a loss, such as fire, windstorm, theft, or vandalism. For example, if a house burns down, fire is the peril. This term is distinct from a hazard, which is a condition that increases the likelihood or severity of a loss from a peril. Understanding the difference between perils and hazards is fundamental to grasping what events a policy is designed to cover. Question 9. An insurance producer who intentionally misrepresents the terms of a policy to an applicant is engaging in what prohibited act? A. Twisting. B. Rebating. C. Defamation. D. Coercion. Answer: A. Twisting. Twisting is an illegal practice where an insurance producer persuades an insured to cancel an existing policy and purchase a new one, to the insured's detriment, by making misleading or false comparisons of the policies. This action specifically involves misrepresentation to induce a policy change, often for the producer's financial gain at the expense of the client. It's crucial for producers to act ethically and always prioritize the client's best interest to avoid such unfair trade practices. Question 10. All of the following are typically covered under the medical payments coverage of a personal auto policy except A. The insured's medical expenses after being hit by a car as a pedestrian. B. Medical expenses for a passenger in the insured's vehicle injured in an accident. C. Medical expenses for an occupant of another vehicle involved in an accident caused by the insured. D. The insured's medical expenses after being injured in their own car. Answer: C. Medical expenses for an occupant of another vehicle involved in an accident caused by the insured. Medical payments coverage in a personal auto policy is designed to pay for reasonable and necessary medical and funeral expenses incurred by an insured or any occupant of a covered auto due to an accident, regardless of fault. However, it does not cover injuries to occupants of other vehicles. Those expenses would typically fall under the bodily injury liability section of the policy, as the insured caused the accident. This distinction is important for understanding who is covered under each part of the policy. Question 11. What is the primary purpose of the Fair Credit Reporting Act, FCRA, in relation to insurance? A. To ensure that all insurance applications are approved within 30 days. B. To regulate how consumer credit information is collected, used, and disseminated by reporting agencies. C. To set minimum capital requirements for insurance companies. D. To protect consumers from identity theft by requiring strict data encryption. Answer: B. To regulate how consumer credit information is collected, used, and disseminated by reporting agencies. The Fair Credit Reporting Act, FCRA, is a federal law that regulates the collection, dissemination, and use of consumer credit information. In insurance, it ensures that insurers use credit reports fairly and that consumers have the right to know what information is being reported about them, dispute inaccuracies, and have access to their reports. This protects consumers' privacy and ensures the accuracy of data used in underwriting decisions, making transparency a key aspect of the law. Question 12. Which of the following is not typically considered a special or open peril covered under an HO3 policy's dwelling coverage? A. Theft. B. Vandalism. C. Freezing of pipes. D. Flood. Answer: D. Flood. An HO3 special form homeowners policy provides open perils or special perils coverage for the dwelling, meaning it covers all perils unless specifically excluded. While theft, vandalism, and freezing of pipes are typically covered under the HO3 dwelling provisions, flood is a standard exclusion found in almost all property insurance policies, including homeowners. Policyholders must purchase a separate flood insurance policy through the National Flood Insurance Program, NFIP, or a private insurer for flood coverage. Always check the exclusions section of any open perils policy. If it's not listed there, it's typically covered. Question 13. Which of the following statements best describes the principle of indemnity in insurance? A. The insured can profit from a loss. B. The insured is restored to the same financial condition they were in prior to the loss, without profiting. C. The insurer must always pay the full replacement cost. D. The insured must prove negligence to collect on a claim. Answer: B. The insured is restored to the same financial condition they were in prior to the loss, without profiting. The principle of indemnity is a cornerstone of insurance, stating that the purpose of an insurance policy is to restore the insured to their pre-loss financial condition, making them whole again, but not allowing them to gain or profit from the loss. For example, if a car is totaled and its actual cash value is $15,000, the insurer will pay up to $15,000, not more, to prevent the insured from profiting. This principle prevents moral hazard and ensures insurance is a recovery mechanism, not a source of financial gain. Question 14. What type of hazard arises from an individual's indifference or carelessness concerning a loss? A. Moral hazard. B. Morale hazard. C. Physical hazard. D. Legal hazard. Answer: B. Morale hazard. A morale hazard refers to an increase in the probability or severity of loss due to an insured's indifference or carelessness. This isn't intentional dishonesty, which is a moral hazard, but rather a relaxed attitude because they know they are insured, such as leaving car keys in an unlocked car. Understanding this distinction helps in assessing risk and explaining why certain behaviors might impact coverage. Question 15. The purpose of the insuring agreement in an insurance policy is to A. List the names of the insured and insurer and policy period. B. Specify the perils covered and the scope of coverage. C. Outline the duties and obligations of the insured after a loss. D. Exclude specific perils or types of property from coverage. Answer: B. Specify the perils covered and the scope of coverage. The insuring agreement is the core promise of the insurance policy, stating what the insurer agrees to do: pay for losses caused by covered perils. This section broadly defines the coverage provided, including the types of property or liabilities covered and the perils against which they are insured. It is distinct from the declarations, identifying info, conditions, rules, and exclusions, what's not covered, serving as the foundation of the policy's protective promise. Question 16. Which of the following situations would most likely be covered under coverage E, personal liability of a homeowner's policy? A. Damage to the insured's own property caused by a fire. B. Injuries sustained by the insured's family member in their home. C. The insured is sued after their dog bites a neighbor's child on the insured's property. D. Damage to a tree in the insured's yard caused by a lightning strike. Answer: C. The insured is sued after their dog bites a neighbor's child on the insured's property. Coverage E, personal liability, in a homeowner's policy provides protection for bodily injury or property damage for which the insured is legally responsible to others. When an insured's dog bites someone, the insured can be held legally liable for the resulting injuries and medical expenses, which is precisely what this coverage is designed to address. This highlights the importance of liability coverage for unexpected events involving third parties. Question 17. An insurance policy is considered an adhesion contract because A. It can be transferred from one party to another without consent. B. It is prepared by one party, the insurer, and accepted or rejected by the other party, the insured, without negotiation. C. It requires both parties to perform specific duties. D. It pays a specified amount regardless of the actual loss. Answer: B. It is prepared by one party, the insurer, and accepted or rejected by the other party, the insured, without negotiation. An insurance policy is a contract of adhesion because its terms are drafted by the insurer and presented to the prospective insured on a take-it-or-leave-it basis, meaning the insured has little to no ability to negotiate the policy's terms. Because of this characteristic, courts typically resolve any ambiguities in the policy language in favor of the insured. This unique nature emphasizes the insurer's responsibility for clear and unambiguous policy wording. Question 18. What is the standard deductible for most perils under a basic homeowner's policy, HO3? A. A flat dollar amount, such as $1,000 or $2,500. B. A percentage of the dwelling's insured value. C. No deductible applies to property claims. D. A deductible that varies based on the cause of loss, but typically a flat dollar amount applies to most perils. Answer: D. A deductible that varies based on the cause of loss, but typically a flat dollar amount applies to most perils. While many perils in an HO3 policy are subject to a standard flat dollar deductible, e.g., $1,000, certain perils like windstorm, hail, or hurricane in some coastal or high-risk areas may have percentage deductibles, e.g., 2% of the dwelling's insured value. Therefore, the most accurate answer acknowledges that while a flat dollar amount is common for most perils, it can vary. Always check the specific policy's declarations page for precise deductible amounts and types. Question 19. An insured intentionally set fire to their own business to collect insurance money. This act is an example of what type of hazard? A. Physical hazard. B. Morale hazard. C. Legal hazard. D. Moral hazard. Answer: D. Moral hazard. Moral hazard refers to the increased probability or severity of loss due to the dishonest tendencies of an individual. In this case, intentionally setting a fire to collect insurance money is a clear act of fraud driven by financial gain, directly illustrating a moral hazard. This type of behavior is distinct from carelessness, morale hazard, or physical conditions, physical hazard, because it involves a deliberate intent to deceive or cause a loss for financial benefit. Question 20. Which of the following statements about an unendorsed dwelling policy, DP1, is true? A. It provides broad coverage for both the dwelling and personal property. B. It only covers personal property, not the dwelling. C. It provides basic named peril coverage for the dwelling, and optionally for personal property. D. It provides open peril coverage for the dwelling. Answer: C. It provides basic named peril coverage for the dwelling, and optionally for personal property. The DP1, or Basic Form Dwelling Policy, is the most limited of the dwelling forms. It provides named peril coverage, meaning only perils specifically listed in the policy, like fire, lightning, and internal explosion, are covered. Coverage for the dwelling is automatic, while coverage for personal property is optional. This form does not provide the broad or open peril coverage found in more comprehensive policies like DP2 or DP3. Question 21. What is the primary function of the California Fair Access to Insurance Requirements, FAIR, plan? A. To provide homeowners insurance exclusively for high-net-worth individuals. B. To offer insurance coverage to applicants who are unable to obtain coverage in the standard market due to high risk. C. To regulate insurance rates for all residential properties in California. D. To provide flood insurance to all California residents. Answer: B. To offer insurance coverage to applicants who are unable to obtain coverage in the standard market due to high risk. The California Fair Plan is an insurer of last resort that provides basic property insurance coverage for individuals and businesses who cannot obtain it in the voluntary market due to the property's location, e.g., brush fire areas, or other risk factors. It is designed to ensure that essential property insurance remains accessible, promoting stability in the insurance market and protecting property owners who might otherwise be uninsurable. Question 22. In the context of property insurance, what does subrogation allow the insurer to do? A. Renew the policy automatically without the insured's consent. B. Recover the amount paid to the insured from a negligent third party. C. Increase the premium retroactively after a claim is filed. D. Decline coverage if the insured has other insurance policies. Answer: B. Recover the amount paid to the insured from a negligent third party. Subrogation is the legal right that allows an insurer, after paying a claim to its insured, to step into the shoes of the insured and pursue recovery from a third party who was responsible for the loss. For example, if a third party damages your car and your insurer pays for the repairs, the insurer can then sue or seek reimbursement from the at-fault party. This prevents the insured from collecting twice for the same loss and places the financial burden on the negligent party. Question 23. An adjuster determines that a homeowner's claim for roof damage due to hail should be settled based on the roof's current market value, taking into account its age and wear and tear. This method of valuation is known as A. Replacement cost. B. Stated value. C. Actual cash value, ACV. D. Agreed value. Answer: C. Actual cash value, ACV. Actual cash value, ACV, is a method of valuing insured property that takes into account depreciation, meaning it calculates the replacement cost of the property minus any deduction for wear, tear, or obsolescence. When an adjuster pays based on the roof's current market value, taking into account its age and wear and tear, they are explicitly applying the ACV principle. This contrasts with replacement cost, which pays for new property without depreciation. Question 24. What is the primary difference between a broad and an open, or special, peril form in property insurance? A. Broad forms cover fewer perils than basic forms, while open forms cover more. B. Broad forms cover specific named perils, while open forms cover all perils unless specifically excluded. C. Broad forms are only for commercial properties, while open forms are for residential. D. Open forms always have higher deductibles than broad forms. Answer: B. Broad forms cover specific named perils, while open forms cover all perils unless specifically excluded. This is a fundamental distinction in property insurance. A broad form policy is a named peril policy, meaning it covers a specific list of perils that are explicitly named in the policy, e.g., fire, lightning, windstorm, falling objects, etc. An open, or special, peril form, on the other hand, provides much broader coverage by insuring against all direct causes of loss unless the cause is specifically excluded in the policy language. Understanding this difference is key to knowing the scope of coverage for an insured. Question 25. Which type of insurance provides coverage for the legal liability of a business arising from its premises, operations, products, and completed operations? A. Commercial property insurance. B. Business auto policy. C. Commercial general liability, CGL, insurance. D. Workers' compensation insurance. Answer: C. Commercial general liability, CGL, insurance. Commercial general liability, CGL, insurance is a foundational policy for businesses, designed to cover a broad range of liability exposures. It specifically provides coverage for bodily injury and property damage claims arising from the business's premises, ongoing operations, products it manufactures or sells, and work that has been completed operations. This crucial coverage protects businesses from potentially devastating lawsuits, distinguishing it from property, first-party, or auto, specific vehicle, coverage.